Joined now by Daniel Morris, BNP Paribas Asset Management Senior Investment Strategist, who's joining us from London. And there's a great deal to talk about all of this, but mostly I guess I would say it's your optimism going forward, that you still see opportunities in equities, and I'm hoping you'll explain it to all of us.
Well, I guess tempered optimism might be the better phrase. I think we've got to keep in mind the U.S. economy is still quite solid. Globally, growth is okay. We know it's not spectacular, but we're not going into a recession this year, at least not as far as we're concerned. So in that environment, it still should be a positive returns for risk assets. The concern is obviously that you have much higher multiples now than you had at the beginning of last year, and so it's going to be more challenging to get very positive returns. But we still think you're going to see higher corporate profits at the end of the year and hopefully a reasonably good multiple on those profits.
And you also think then, therefore, that those multiples that we're seeing now are not too high, as particularly I know that you're looking at sort of sector by sector PEs to distinguish and to sort of peel back where the growth is coming from.
Exactly, because what's been very notable over the last couple of years is the rising dominance of technology. Of course, this is not a new phenomenon, but over the last 2 years, since we had the S&P 500 at roughly the same forward PE, about 18.5 times. Over those last 2 years, you've had the PE on the technology sector, broadly defined, go up about 16%. Whereas you've had the multiple on the rest of the market actually going down. So on average, you look like you're at the same PE today as you were at 2 years ago, right before you had the sell-off in the market. But at a sector level, it's much higher multiples on tech, lower multiples on the other sectors, and then you have to think about, well, whether those multiples, particularly for the tech sector, are justified or not.
This is Jared Blicker. I wanted to ask you about the interest rate environment. We got the Fed on hold, so I'm really focusing more on the long end. Well, yield curve is contracting. The 10-year is at 1.70. That's the lowest in about 7 weeks. Then we have the U.S. dollar. That's surging. The U.S. dollar index is about at the highest in 7 weeks. How does that factor into your analysis, if at all?
Well, I think the key thing to keep in mind is if we look at the returns that we had last year, which of course were outstanding, even when you had essentially zero earnings growth for the year, we'll see what we get with the current earnings season that's being reported, but expectations are it's going to be about zero, maybe even negative year-on-year earnings growth, but you still had, of course, 25% or so gains in equity markets. And one of the key drivers for that, besides multiple expansion, was the fall in interest rates. Now, this year, with the Fed more or less on hold until after the election, you're unlikely to get that kind of support, irrespective of what happens with 10-year Treasury yields. So that's clearly a much higher barrier for much appreciation in the market, which what gets us back to we really need to see solid earnings gains over the course of the year. And what we're really going to be looking for out of this earnings season is a corporate guidance that companies give to let us know whether the confidence we have in, say, 10% or so earnings gains by the end of 2020 are realistic or not.
Daniel, what mistake might investors be making who are a little nervous and want to seek out some value stocks? I mean, like energy really hasn't performed that well. Are there other mistakes that you could help them avoid?
Well, I guess you could argue all of last year or last several years has been a mistake from a retail investor point of view, because, of course, you've had redemptions, broadly speaking, from equity mutual funds. Now, what I think is a bit comforting, if you will, at this point, is though a lot of that money did go into fixed income funds, actually about twice as much money went into money markets. So a lot of people actually are sitting on cash, having been nervous about the equity markets. Clearly that hasn't manifested itself really quite yet. But if, more likely when you do see a bigger correction in the market, I think at least we know there is cash on the sidelines. And given that we think the underlying fundamental outlook, particularly for the U.S. economy, is still good, I would anticipate that people will buy the dip and then ultimately will support the market and keep it from falling really too much.